The residential property market isn't the only playground pumped up by low interest rates and foreign investors. China is pouring billions into commercial property, and the sector is heating up, encouraged by high returns, soon to be followed by higher prices. But is a correction coming? The market trends triggered a warning against complacency from the Reserve Bank, which drew attention to the financial threat posed by a commercial property collapse. Here's finance correspondent Philip Lasker.
Chinese investors have made their mark on the Australian landscape. Their buying isn't restricted to residential property and farmland. They've been snapping up large swathes of Sydney and Melbourne's CBD. More than 40 Chinese companies are buying up commercial real estate in the major capitals. We're on track for $5 billion in Chinese investment in Australian commercial real estate this year.
I don't see anything to change that. It will grow. We have seen very strong growth rates in the last 5 to 6 years. If anything, I see that might slow down as the rest of the world improves, but I don't see that going into reverse.
In just 3 years, Chinese capital flowing into global real estate markets has almost tripled. 25% of that increase is investment in Australia. The money's still coming in despite the equity market turmoil in Shanghai, concerns about a slowing economy and attempts by Chinese authorities to curb capital outflows.
It may have a negative impact. Equally, of course, from the investments point of view, if you're sitting in China, you're looking for higher returns, you may find that your higher returns are to be found by going offshore. So a slowdown in China really can be explained or can be interpreted two ways. As far as we can see, at the moment, there's no evidence of a slowdown.
Global commercial office yields in Australia are amongst the highest in the developed world, over 6% and well above the bond rate. Attractive pickings in a low interest rate environment.
We'd expect that to narrow over time, but that doesn't mean the capital goes the other way. That just means we'll see a slowing in the inflow of what is a large and growing pool of global capital looking for real estate investment.
As the mining boom wanes, the flood of offshore money into commercial real estate has helped keep Australia out of recession. But for the Reserve Bank, which has witnessed the big city interest rate fuelled residential property boom, the commercial market can't be ignored as a looming economic threat.
It is these segments of lending that tend to grow in importance in the late stages of a boom and to account for a disproportionate share of loan losses in a bust.
While Australian banks have a far higher proportion of their loan books exposed to residential home loans, it's lending for commercial property that's more risky.
And if we're looking for surges in credit growth as precursors to painful downturns, we should bear in mind that historically, these surges have been evident in business credit far more than in housing credit. That's certainly what we see in the Australian data.
The industry is dismissing the warnings.
We don't see particular risks arising in most of the commercial markets, that's office markets, retail, industrial markets in Australia. So I think our position would be that the Reserve Bank seems to be overstating the position.
But if offshore investment dries up, it will hit property prices and construction hard and undermine one of the pillars of growth for the Australian economy.